You're listening to Fund Flow, a podcast for emerging managers offering insights into the journey of new and aspiring fund managers seeking to have access in a crowded market. Tune in as McGuire-Woods partner and host, John Finger, is joined by guests ranging from first-time fund managers to proven emerging managers, experienced LPs poised to back emerging managers, and other key participants in the emerging manager ecosystem. Hear their real-world perspectives and gain actionable tips to help inform your strategy and position yourself for a successful fund closing.
Welcome to Fund Flow, a McGuire-Woods podcast for emerging managers. I'm John Finger, and today I'm very excited to be joined by Whit Matthews. Whit is a managing director at Hivista Strategies, a Boston-based firm focused on alternative investments. Whit is a senior member of Hivista's private equity team, which focuses exclusively on the lower middle market, and he is a member of the firm's private equity investment committee. Whit joined the team in 2016 as he is responsible for all aspects of the investment process at Hivista. That includes portfolio construction, due diligence, ongoing monitoring of existing and prospective fund commitments, co-investments, and secondaries. Prior to his current role, Whit was a member of the private equity team and investment committee at SL Capital Partners. And before that, he was an investment professional at the University of Pennsylvania Endowment, allocating to private equity, venture capital, and hedge fund opportunities. Whit, thank you so much for joining us today.
John, it's great to be here. I'm glad we're finally doing this.
Well, let's start with, Whit, if you would share with the audience more about your background and ultimately what led you to Hivista Strategies.
Yeah, no, I'm happy to. Before I jump into me, I just want to take a quick second. I just want to say thank you to you, John, and to all your colleagues at McGuire-Woods. You guys have been absolutely tremendous stewards and advocates for the lower middle market and the independent sponsor private equity ecosystem. I know we're going to spend, a lot talking about that, but you guys have been great partners to everybody in the ecosystem. You've been awesome partners to us here at Hivista. You guys have really stepped up and filled a void in this investment community, both for GPs and for allocators. Your conferences have literally become the most productive events that we attend annually. And I know that's a view that's not just shared by the Hivista team, but everybody in the lower middle market ecosystem. And, I just want to say before we jump in, it's been great getting to know you personally and professionally and all your colleagues at McGuire-Woods. I just want to say thank you before I jump into my story.
Well, thank you, Whit. We obviously very much appreciate that. And I'm glad to see we put the paid commercials early in the program.
No, we mean it. So listen, a little bit about me. So I grew up in a small town in Rhode Island, outside of Newport, Rhode Island. My parents moved there just before I was born. They live in the same house that they lived in when I was born. So we get down there pretty regularly. My first job was a paper route. And as I got older, I kept myself busy in the summer months doing things like washing cars and mowing lawns. When I turned 14, which was the legal working age in Rhode Island, my parents made me get a quote unquote real job. And I actually got a job as a janitor, of all things, at the local Marriott hotel. They called it a houseman, but it was a janitor. I was fortunate enough to go to a small high school in Connecticut that was called the Gunnery when I went there. It's called the Frederick Gunn School today. My father actually went there in the 1950s, which is a pretty cool story. And my brother went there after I did. But it was really a transformative experience for me. And I owe a lot of who I am today and my experiences there. It really just helped shape who I am today. And it was a special spot. And I was glad I got to do it. During the summers, during high school, I kept working at the hotel. I eventually worked into a more customer-facing role at the front desk, which was rewarding, and I enjoyed my time there. After Gunnery, I was fortunate enough to get into a school in Philadelphia. I went to the University of Pennsylvania. I'd never been to a big city before. I'd never been that far south before. I always joked that I thought I was going into the deep south and I expected southern accents. And when I got there was definitely accents, but they weren't southern accents. And so Penn was great for me. I played ice hockey at Penn, met many of my very best friends through that. Maybe most importantly, I met my wife. We just celebrated our 20th wedding anniversary this past June. So Penn was great. When I was at Penn, I was a work study student. I worked at Penn's health system in a finance role. And after graduation, I actually parlayed that work study role into a full-time opportunity. And while I was doing that, I was able to get my MBA out at Villanova on the main line down there in Philadelphia. My first foray into investments really was a stroke of good luck as I was finishing that MBA program. Kristen Gilbertson was the newly appointed CIO at Penn's endowment. She had joined there from the World Bank and Stanford University, and she was really looking to build out an investment office that looked a lot like the Yale endowment model. and she was looking to hire her first associate. And I came across the job posting. Ironically, she was looking for somebody with 2 or 3 years of investment banking experience in New York. I didn't have any of that. And she was looking for somebody that was pre MBA, and I was just finishing my MBA. But I got the interview. Kristen took a bet on me, she took a chance on me. And the endowment proved a great training ground for me. I obviously got exposure to private equity where I've built my career. We're going to spend some more time talking about that. I was able to work on the hedge fund portfolio, the venture capital portfolio. The entire endowment experience, it was really great. And some of the folks that I worked with when I was there are actually still at Penn's endowment, and I call them friends, and we stay in touch today. 3 years after I started at Penn, I was approached by a headhunter for a UK firm that was looking to build a lower middle market private equity team based in Boston, which is where I'm based today. And, I mentioned before, I'm from New England. So I jumped at the opportunity. This was back in 2009. And it was after that point, the next kind of 5 years, when I really started to immerse myself in the lower middle market private equity ecosystem. And that's where I got to know my current partners, Scott Reed and John Dickey. They were at Flag at the time, and we got to know each other through the Boston network, through various shared limited partner advisory board seats, through the conference circuit. They were nice enough to formally ask me to join them in 2016. And it's been an incredibly successful journey since we all came together. We've raised and invested multiple funds. They're all focused on the lower middle market. And today, we're investing out of our 10th fund, again, focused on lower middle market. And we make co investments, we make fund commitments to emerging managers, we'll do opportunistic secondary commitments, and we're really active in the independent sponsor ecosystem. So that's how I got to High Vista.
That's fabulous. Thanks so much for the story. And Penn will always hold a place in my heart. I tell people both my parents went to Penn. My brother went to Penn, and I was the black sheep of the family and went to the University of Arizona.
That sounds more fun.
No comment, but that's good stuff. Maybe spend a little bit, Whit, and talk about the differentiated approach at High Vista to private equity.
Yeah, sure. Let me start at a high level. I'll kind of just describe High Vista, who we are, and then I'll double click on how we think about private equity and what we're doing day to day in the private equity ecosystem. So today, High Vista, it's an $11 billion firm. We're entirely employee owned. We're all based here in Boston. And at the highest level, we're focused on the pursuit of alpha across various alternative investment strategies. The firm's been around 20 years. We're actually celebrating our 20th anniversary this year. We're going to have a fun event in early June to celebrate. And our founder and CIO, Andre Perol, likes to refer to our focus as looking for beautifully inefficient markets, whether they be public or private. And the goal across all of these strategies is to generate alpha, and to do that, especially in areas of the alternatives landscape that's difficult for our clients to do by themselves, difficult for them to do directly. So, on the public side of things, we manage a portfolio of assets that are focused on US small cap biotech investing. We also manage an endowment style portfolio, which offers investors multi asset exposure across geographies and investment approaches. We have a private credit team, and our colleagues there are focused on building portfolios of various kind of non correlated specialized lending themes. We've got a sister venture capital team. They've been investing in the space for over 20 years. This strategy is a really neat one. It was actually originally founded by Peter Lawrence and Diana Fraser. They're really luminaries in the venture capital investing space. The program today is led by one of their proteges, Kirsten Morin. And that business, they just have a tremendous track record of backing some of the most well known and most access constrained venture capital firms. And then our private equity strategy. So, the team that I'm a part of, we're focused on the smallest end of the lower middle market. So we often refer to it internally as the small cap or the micro cap private equity ecosystem. At the most simple level, what we're looking to do is invest in founder and family owned small businesses. And we're doing this alongside highly specialized and experienced GP partners. I referred to it a little bit before, but our portfolio construction is a mix of co-investments directly into these small businesses, and then a mix of fund commitments to lower middle market managers, often emerging managers that are investing into these same small businesses. We're really proud of the fact that we've got a deep history of partnering with firms that today are actually really well-known, larger firms. when they were much smaller before they were institutional. And so over our history, we've made over 150 fund commitments. We've made more than 100 co-investments, and we've done those alongside dozens of funds, ones, twos, even threes. And we're really active in the independent sponsor space, like I said before. So emerging managers, lower middle market managers, that's what we do. That's the ecosystem that we eat, sleep, breathe every day.
That's great. Before we talk more about details on your strategy, maybe tell me a little bit about how you built the team at High Vista to execute on all the different strategies, and in particular, lower middle market private equity opportunities.
Yeah, I appreciate the question. And I love the question because we're super proud of the team we have. We've got a really special group of people that are focused on everything we do at High Vista and particularly on the private equity side of things. So I mentioned John and Scott earlier. They co-head our lower middle market private equity program here at High Vista. And they bring a really differentiated and kind of unique DNA to the table, having both began their careers as principal investors. So John was at Berkshire Partners here in Boston. Scott was at J.H. Whitney earlier in their career. We believe this experience as principal investors really helps us stand out when we're partnering with managers in the lower middle market. We've sat in their seats before. So we've really purposely built the team with folks that have experience similar to this, such that we can execute most effectively on investing in the lower middle market. So our most recent hire, and it was years and years ago now, was a gentleman, Rob Nagel. He joined us back in 2018. He started his career at Bain here in Boston, and then he was part of the team that spun out of Golden Gate to form a firm called Altamont Capital. So he also brings that same principal investment experience to the table. Ryan Tiffany's been a part of the team since 2008. He joined from a consultant that was working directly with the portfolio companies of lower middle market businesses. I mentioned my experience at the endowment. I'd also be remiss if I didn't mention our two outstanding vice presidents that are on the team. They've both been with us for over 5 years. Andrew Gonzalez joined us from a local consulting firm called ETA, very well regarded in the region. He's been terrific. And then Jordan Kempfel joined us from the Partners Healthcare Endowment, also here in Boston. So those guys have just been tremendous parts of the investment team, and we really love working with them. We've also got 3 dedicated associates that are focused on the private equity investment strategy. And I'd be most remiss if I didn't mention kind of everybody else that supports the program. So we've got over 40 people in various operational roles, think legal, compliance, finance, investor relations. I'm sure I'm missing folks, but there's lots and lots of people that support the private equity program here at High Vista. And we're really proud of the team that we have. And it's a really special group.
No doubt. Thanks for sharing that, Whit. As we spend a little time talking about the strategy at High Vista, maybe we start with hearing your perspective on the role that independent sponsors play in your private equity strategy.
Yeah. I think independent sponsors and emerging managers more broadly, it's a huge part of what we invest in. And it's certainly a huge part of where we spend our time. I'm guessing that everyone who listens to this podcast, maybe aside from my mom and dad, will be well aware of these statistics. But we all know that the opportunity set here in this part of the market is really fantastic. I'm stealing this line, but a few weeks ago, we had a new emerging manager come through the office and they said the lower middle market is the last bastion of alpha in private equity. We love that line. We absolutely ate it up. I think there's something to that. I think we all know that historically, the very best small managers and small deals, so think top quartile managers and deals, they've outperformed other parts of private equity. But we all know that the opportunity set, right, is really big in this part of the ecosystem. There's lots to sift through, and not all investments are created equal. So manager selection and deal selection is really important. I talked about our team, and we pride ourselves on sifting through all of these sponsors and all of these deal opportunities every day. And it's a lot of hard work. And, to put a finer point on that, we're tracking roughly 500 active independent sponsors today. We see roughly 350 actionable co-investments every year. And that's all in addition to the 200 funds that are raised every year in the lower middle market. So it's lots and lots to sift through. I mentioned the 150 fund commitments that we've made. I mentioned the 100 plus co-investments that we've made. If you peel back those numbers, roughly 40% of what we've done in each of those baskets are either to first time funds or independent sponsors. So the emerging manager ecosystem is just a huge part of our investment philosophy. And listen, we're big believers that size, bigger funds, larger deals, they can be the enemy of return. And we've just tried to stay consistently focused on the lower middle market over time.
That is exactly how we feel about it. And I appreciate the perspective. So when you look at fund ones, new fund managers, what are some of the key factors, LPs, and then more specifically, right, at High Vista, what do you look for when you're assessing those jockeys?
It's a lot and it's more art than science. And I know you've talked to a number of people that sit in seats similar to the ones that we sit in here. And so I'm sure I'm going to echo, some of the comments that you've heard from others on this podcast in the past. But, listen, we're constantly on the lookout for managers that really have a specific, specialized reason to win. Typically, that's born out of their prior experience and it's brought to fruition in the form of some type of sector expertise or expertise in some type of investment style. And so we're always looking for that. We really like teams of individuals that have worked together in some capacity previously. Obviously, time together at the same firm is ideal, but the independent sponsor model, and we'll spend a little bit more time on that, has proved a great avenue for newer manager relationships to come together and allow folks to get these reps before they become emerging managers looking to raise funds. Teams are really important to us here at High Vista. We like backing multiple people as opposed to backing individuals. All of our senior investment professionals, played team sports when they were growing up and many of us through college. And we're big believers that 1+1 can definitely equal something much more than two. So we love team dynamics. Another factor that we spend a lot of time assessing and trying to understand is the ability to source unique and differentiated deal flow. We think it's hugely important. Everybody says they have a proprietary deal. We kind of believe that that's kind of a unicorn in the marketplace today. But we love differentiated deal flow. And when we think about deal flow, it's obviously the lifeblood of these emerging managers and these lower middle market managers. But we're keenly aware that if you're sitting at a middle market private equity shop with a shiny business card, you're likely to see everything. If you hang your own shingle for the first time, I think sourcing is a big TBD. And so, we really hone in on how they're going about building their sourcing funnel and how about they're going about to build a relationship and build their own brand out in the market. So we spend a lot of time on sourcing. Outside of those things, we do very deep referencing on every new relationship that we bring through the doors. We'll look to speak with nearly every individual that, senior partners have worked with in the past. Nothing provides better perspective than talking to folks that have been in the trenches with these individuals. Most of these managers don't have a traditional track record or an attributable track record from their prior shops. So we look to build those organically, and these calls can really help bring those prior experiences to light. I think the last thing I'd just say, we're very focused on alignment of incentives, and we all know that nobody's getting rich at this end of the market on fees. And we really love that dynamic. In order for our GPs to be successful, we have to be successful. And we obviously love that dynamic. And we've also honed in on an investor profile that, has worked for us repeatedly. We really like backing individuals that have that traditional middle market, lower middle market, private equity training, typically kind of 10 to 15 years of experience. They've had reps, they've seen a lot, but they're betting on themselves, right? They didn't ring the bell in their first role. Things have to go right early on for them to be successful over the long term. And so, we're not mutually exclusively focused on that profile, but it's a profile that we really, really like.
That's great. Super insightful. I appreciate that. You touched on secondaries. What role do secondaries play in High Vista's strategy?
So they're a big part of the private equity landscape. And for us, secondaries are kind of really a tool, if you will, in the toolkit. So on the investment side of things, we'll definitely look to opportunistically lean into, LP secondaries where we believe that we have a differentiated perspective. So, we believe that secondary market is really darn efficient and there's lots of things that are very efficiently priced. And we're not going to chase a lot of those mid cap and larger cap names that are traditionally traded in the secondary market. But many of the lower middle market managers that we track and spend time with day to day, they're not well known by the larger secondary players out there. And this provides an opportunity to price certain names, more efficiently and more effectively. And so we will pursue those opportunities opportunistically. GP-led continuation vehicles, they've obviously become a huge part of the secondary landscape. Some years they've accounted for over 50% of the market. Each one of these situations is unique, but for most of the single asset situations that we see and that we look at, we treat them no differently than a co-investment, right? We'll take a direct bottoms up underwriting approach and we'll make a decision from there. Lastly, in our role as an LP and a fund manager, we're constantly re-underwriting our own portfolio on an annual basis, and we'll take a view on which positions in our portfolio we want to hold versus those that we might consider selling. So at the very end of last year, as an example, we actually fully wrapped up three of our legacy vehicles in the secondary market. And through this process, we were able to get some capital back to our investors in a year in which regular way distributions were pretty hard to come by. And they definitely appreciated that. And we were very happy to get those vehicles wrapped up. So it's a tool in the toolkit. There's a lot of ways we can use it. And it's definitely a big part of the entirety of the private equity ecosystem and the lower middle market.
Absolutely. Zooming out a little bit, and up to you if you tackle this question at the broader macro level or the current events, if you will, of the day. But how do you believe macroeconomic trends and the environment at the macro level that we live in today affect deal flow, affect valuations, and then ultimately affect private equity firms?
At the highest levels, right, everybody knows deal flow, no matter what metrics you look at, and fundraising had been down pretty meaningfully since the highs that we saw in 2021 and 2022. A lot of that has been driven by shocks to the economy, a lot of uncertainty as we headed into the elections at the end of last year. And I think there were some green shoots as we kind of turned the page into 2025 that deal volume would pick up. It's early April of 2025 as we record this. And I think, the reality is that there's still lots of ongoing uncertainty and volatility in the markets. And I think the reality is that most folks, at least in the lower middle market, and I think in mid cap and larger cap private equity as well, folks have just continued to sit on their hands. It feels very similar to kind of the messaging we were telling ourselves as we went into the end of 2023, where everybody kind of thought, M&A activity was going to pick up in the first half of 2024, and it never really came to fruition. So we're using the phrase internally of slower for longer seems to be the reality. I think that's certainly the case for the first quarter of 2025, and we expect it to be the case for probably the first half of 2025. We'll see where things play out in the second half of the year. We remain cautiously optimistic, but slower for longer seems to be the reality that we're living in. On the valuation side of things, it appears that the spread between buyer and seller expectations is still pretty wide for most businesses. And I think this is really driving that decreased deal volume that we've spoken to. That said, we have observed, and this was consistent across 2024, and it has been consistent in the first part of 2025, high quality businesses, so those that are kind of growing nicely, those that have diversified customer bases and strong margin profiles, those businesses continue to trade for healthy multiples. Just this past week, we actually had one of our managers that sold a business for a double digit, apologies, return of capital. The deal literally is going to return the fund. The business was in an adjacency to the broader home services roll up plays that we've seen over the last 5 or so years. But business was a first mover in the space that it played in. It wasn't a late innings kind of HVAC or landscaping roll up play. Not that there's anything wrong with those. We've had tremendous success in both those spaces, and we've got existing portfolio companies that are doing really well in both those spaces. But this was a first mover in the end market they were playing in. The business itself had literally grown both organically and through M&A from a low single digit kind of EBITDA business to a mid teens EBITDA business in just less than 3 years, I think. And the business ultimately commanded an exit multiple of 14 times cash flow from a mid market private equity shop that we would all know. And to us, this is a classic example of our build inventory in the lower middle market and the small cap ecosystem to sell up the private equity food chain thesis. Our observation is that high quality businesses continue to trade in this market, but everything else, that buyer versus seller expectation continues to be pretty wide. And I think that's leading to the slower deal volume that we continue to see in the first part of the year here.
Absolutely. So you touched on a few of them, but what other material challenges do you think are most prevalent facing private equity firms in the lower middle market today?
Yeah, I mean, I'll harp on a little bit of what we just spoke to, or at least all of what we just spoke to. I think lack of deal activity and lack of liquidity, they're clearly at the top of the list for everybody in the private equity ecosystem, and particularly in the lower middle market. Investors, LPs, are anxious for distributions. The lack of cash flows back to those investors, kind of coupled with this denominator effect we're feeling, at least as we kind of sit here today, it's making it very hard for lower middle market managers, whether they're new or established, to raise capital in this market. So I think getting distributions back to investors, getting deal activity going is at the top of the list of challenges. I think it's worth commenting that the marginal LP today is a little bit more risk off versus risk on. And for most people, lower middle market or small cap private equity isn't at the top of the kind of safe to do list. We don't ascribe to that view, but we certainly observe that folks that are allocating to private equity in earnest tend to be allocating to the mid cap and large cap guys because there's some perceived safety with those types of managers. So it makes it hard for these lower middle market managers to raise capital. Like I said, we're obviously not of this mindset. We've got a team that's dedicated to navigating these waters. And history has shown, we all know it, that times of uncertainty or distress are often the best times to invest and generate the best long term returns. So we feel really fortunate to have a consistent strategy that's focused on allocating capital to this part of the ecosystem. And we're excited about the opportunities that are going to present themselves to us over the course of the year.
So, in light of the current fundraising environment, I know you spend a lot of time talking to GPs. What advice do you give GPs who are looking to stand out amongst the institutional investor community?
Yeah. I mean, I guess first off, just in terms of advice, right, be prepared to take it slow. Very few folks are moving through market efficiently, or certainly as efficiently as they'd hoped. We commented, right, raising capital in this market, it's super difficult. And listen, for many, and I think one of my biggest pieces of advice would be the independent sponsor route may make a lot of sense in this market, right? Go out, find a good deal, find a few partners, generate some great returns, and then come back to market, to raise a fund after you've put a few proof points on the board. So we love kind of managers pursuing that independent sponsor model as opposed to kind of rushing after fun in a market that we know is going to be really difficult. I think if you do push forward with a fundraise, be humble. I think be transparent. The process is going to take a lot longer than you think. It's going to involve a lot more meetings than you think, lots of data requests. Just be patient, be humble, and be transparent. For us, as we sit here today and we kind of go through our weekly pipeline meetings, we've got dozens of actionable fund opportunities on our plate right now. And they've all got their merits, and only a few of them are going to get done. I guess the last thing I'd say is visibility helps, right? And it's a little bit of kind of the chicken or the egg phenomenon, but to the extent that you can provide visibility into deals one or two, potentially provide some co-investment, those are going to be the situations that might get a little bit more attention from allocators and LPs like ourselves. It's not always easy to do, and you can't kind of force a deal to get done unnaturally, but visibility definitely helps when you're trying to raise a first-time fund in the form of potential early deals.
This question I know is not going to be easy to answer without having a specific GP in front of you, but I'm going to ask it anyway. When a manager comes to you and says, should I keep doing deal by deal, independent sponsor strategy, or should I raise a fund? How do you help them analyze the right answer to that question?
It's a terrific question. I think a lot of it goes back to the motivation of the GP and the GP partners, right? Specifically, I always use the anecdote of if anybody finds their way to the opposite side of a conference room table at High Vista here, they're probably a pretty darn good investor. And they've done some things right over the years, and they've got the investment acumen and the skill set to do good deals. Raising a fund and building a firm is a different endeavor than doing good deals. And so, we spend a lot of time with managers who are grappling with the question that you just laid out in terms of just understanding their motivation, right? Do they want to build a firm and have many employees and many portfolio companies and many limited partners around the table? Are they truly looking to be an entrepreneur, if you will, and build a business versus that individual who may be less interested in those things that I just described, but might be really great deal doers, right? And so I think for those individuals that are deal doers, the independent sponsor model may make a ton of sense. You can generate really great wealth for yourself, and you might have to deal with less of the kind of firm management dynamics that you would have to deal with if you raised a fund. And again, that could involve limited partner relations. It could involve, managing portfolio companies. It can involve all the back office and regulatory stuff that comes with raising bigger funds. So it's a little bit of just honing in on the actual motivations of the GP and the partners themselves.
Great insights. Thank you, Whit. How about the role of co-investments in Hivista's strategy? Has that role evolved over the years? And how do you see these LPGP partnerships changing in the future?
So co-investments have played a role in every single one of our portfolios dating back to 2012. So that was our Fund 5. We very consciously took what we kind of refer to as a crawl, walk, run approach to get to where we are today from a co-investments perspective, which is an allocation of, depending on the fund, anywhere from kind of 30 to 45% of our portfolios to co-investments and direct deals. And sometimes that comes in the form of kind of seasoned fund commitments as well. We don't anticipate moving off of these allocations that we're at today. We've been here for a few funds. And the reason is we spent a lot of time analyzing our own portfolio construction. We believe that at these levels, we can build really well diversified portfolios, which mitigate a lot of downside risk, while at the same time maximizing the opportunity for outperformance with these very specific allocation levels. You asked about just kind of the changing LP GP dynamic. We don't see it changing dramatically. It's obviously always evolving. I guess evolution is a form of change. But listen, we look to be partners with our GPs. We're an open book to our GPs. We sit on the limited partner advisory board of every fund that we commit to. We're really, really proud of that. And that provides a forum for regular, ongoing, direct dialogue with our partners. And that's really what they are. They're partners. We've been at it for a long time. I mentioned kind of all the co-investment we've done through our fund commitments. We've got visibility into kind of plus or minus 1,000 other portfolio companies. So everything we see from a new deal perspective or from a situation perspective rhymes with something else that has happened or that has been done in our portfolios. And so we're constantly trying to bring those perspectives, those experiences to bear. We're constantly trying to lean on the pattern recognition that we've developed over the years. And we're looking to share those insights and that visibility with our GP partners such that we can help them be better investors and better partners over time.
So you've spent a good bit of time giving great advice to the GPs, which is hugely appreciated. What are some of the biggest challenges and opportunities that you see for the LP community over the next few years?
For the LP community, I think there's a couple things. I think liquidity is kind of top of the list. And I talked about what we've done on the secondary front in terms of finding ways to manufacture liquidity in certain positions that we think it makes sense to sell. And so, I think for all LPs, giving some thought to, how they leverage the secondary asset class, if you will, as a tool in the toolkit is important. You spoke to challenges. I think the lack of distributions has made it harder for certain groups to continue to invest into the private equity ecosystem. We feel really fortunate here at Hivista that we raise funds every handful of years with a dedicated mandate to continue investing regardless of where we are in the cycle. And so we're going to firmly lean into that opportunity set. But, I do think for many LPs that, that lack of liquidity is going to make it more difficult to allocate on a consistent basis if they're not getting distributions back to them.
And then I guess finally, you've given a lot of great nuggets for the GP world. But when you sit down with a fund manager this afternoon, what is the one piece of advice that you would give them to navigate today's market?
Yeah, we talked to lots of managers, and like we said, this fundraising thing is not easy. It's hard. I think if there's one thing we consistently look for from our partners and our most successful partnerships, it's transparency, right? And transparency has never been more important. We encourage folks to share everything, whether it's existing managers or prospective managers. Share the good news, share the bad news, make sure your investors, make sure your prospects, make sure your CEOs, your management teams know what's going on, right? Don't hide anything. It's all going to come out eventually. And I think the more transparent and the more open that you can be, the better. I think, sharing lessons learned, it's a sign of humility. It's also a sign of strength. You guys are, if I'm saying you guys, but if I'm talking to a GP partner, right? They are building a partnership, right? It's right in the name of everything we do, general partners and limited partners. And we really encourage folks to take that to heart, right? These are long-term relationships. These are partnerships, and we encourage folks to treat them as such.
That's fabulous advice. Well, Whit, thank you for joining me today on FundFlow, sharing your insights, sharing your journey with the emerging manager ecosystem. And thank you to our listeners for joining us on this latest episode of FundFlow. We hope you join us again next time.
Thanks, John. That was a lot of fun.
Thank you for joining us on this episode of FundFlow. To learn more about today's discussion, please email host John Finger at jfinger@mcguirewoods.com. We look forward to hearing from you. This series was recorded and is being made available by McGuire Woods for informational purposes only. By accessing this series, you acknowledge that McGuire Woods makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this installment. The views, information, or opinions expressed are solely those of the individuals involved and do not necessarily reflect those of McGuire Woods. This series should not be used as a substitute for competent legal advice from a licensed professional attorney in your state and should not be construed as an offer to make or consider any investment or course of action.